All right, let's talk a little economics here. So we got the jobs number. Now, listen, I got a lot of things I got to go over on this video. Okay, so just bear with me. A lot of things I got to go over. First of all, the number was weak. I said there would be a strong number. However, and this was brought to my attention by a very astute subscriber of mine. He said, Mike, when you look at the daily Treasury statement, employment and withholding tax deposits, those tax deposits can go up if more people are employed, or those tax deposits can go up if people are earning more money and not necessarily more people coming into the workforce. Aha, that's correct. And that's, one of the things I overlooked. I mean, I understand that. I just, in this particular analysis that I did, I wasn't considering that. I was looking at the employment and withholding tax data as a kind of a barometer for that payrolls number. But really what we saw in the payrolls number, or I should say what we saw in the employment and withholding tax data, which was very strong, I told you it was up almost 16% over November, that reflected a strong rise in wage growth. And we saw that in the report. Okay, the Bureau of Labor Statistics released the report that said wage growth now is growing at 2.9% year over year. That's the highest rate of wage growth in 8 years. Okay, and that 10-cent gain in hourly earnings, average hourly earnings in December, that's twice as fast as what we have seen in the last 2 years for a monthly increase. All right, so there it is. It had that predicted. I just was focusing on the number of payrolls, but actually, it hit the wage growth. Now, there's a couple of things I want to get into here with this wage situation. All right. I mentioned in the past, I may have mentioned, I wrote about it on one of my Street.com reports columns, that we may be getting into this kind of stagflation scenario again. All right. And remember back in the 70s, that's when you had rapid wage growth, economic growth didn't really keep pace, and you had that cost push inflation. You had that whole period of inflation. Of course, the inflation was driven also largely by, we had 2 oil embargoes, so that was a big deal. But now what you see happening, or what I see happening, is that wages are rising rapidly. By the way, the Fed is way behind the curve here. So if they think like that their rate hikes are intended to, keep ahead of inflation or keep ahead of that wage growth, they're behind the curve. I mean, it's growing at 2.9%. The inflation rate is what, 1.7%. So that's more than a full percentage point above the inflation rate right now. So what's going to happen? It's going to push that inflation rate higher. It's going to push it higher. And here's why. If you look at business productivity, I just checked this out. If you look at non-farm business output per hour of all persons, year over year growth, you know what that is? 0. No productivity growth. So people are making more money. The output in real terms is not really increasing. What does that mean? You got the same amount of stuff, but people making more money, boop, boop, up goes prices, right? So you got inflation. So to me, the whole situation now looks like we're going, it's back to the future, man. It's like going back to the 1970s. Maybe not as intense, because, we don't have an oil embargo going, at least not yet. But, and by the way, now that I mentioned that, what's OPEC doing? They're cutting output, right? So we got the scenario. It's the 70s. So what happened in the 70s? The stock market did nothing. It did nothing. It went up to 1,000, then it went back down to 700, then it went into the 900s. For 16 years, it basically did nothing. So here's what I think is going to happen with stocks. I think, will the Dow reach 20,000? Absolutely. What should you do? You sell above 20,000 because it's going to come right back down again. All right, because this increase in inflation has to be at some point discounted by the stock market in terms of real output not increasing. Prices going up, yeah, but real output, the amount of stuff, because labor productivity is zero, it's not growing, the amount of stuff doesn't really increase. All right? What does it mean for gold? And commodities, which are good assets when it comes to inflation. They're going up. And forget about what's happening today with the zombies selling it. What happens to the dollar? That's going down. Inflation is not good for a currency. All right, what is inflation? Your money buys less, right? So the exchange value of the currency goes down. And what does it mean for bonds? They're going down because the Fed, here's the thing, the Fed's behind the curve, number one. And number two, when they raise the rates, it feeds into income. And like I said, the income's going up, but the output of stuff is not really going up. So it's just driving the inflation. Same thing like the 70s, man. Same thing like the 70s is what's going on here. So that's what's going on, all right? Now you all know there's no reason why you shouldn't make a lot of money right now. Bye.